Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodities space. I am Manisha, Gupta. Well, it has been a turbulent week for commodities this time around, thanks largely to the ongoing trade war between the US and China after the US proposed its move to impose import tariff on Chinese products. China retaliated in a spectacular fashion. China is all set to levy a $50 billion worth reciprocal tariff, which will hit mainly the agriculture commodities exported out of the US. China is going to impose import tariff on soybean, wheat, corn, cotton, sorghum, tobacco, meat products, etc. This move is set to specifically target the states that supported President Trump during his campaign. Now, to discuss further in detail on what it really means for the global commodities as a whole, we have with us Jonathan Baratt of Ayers Alliance, and also joining us is Aakash Doshi of Citi Research. Gentlemen, hi, thank you so much for joining us. Aakash, let's start with you first, and let's get into the bone of contention, the US-China trade war. China is a major consumer of many agro-commodities. How do you think the tariff imposition by China will impact the US and the global commodity prices?
Thanks, Manisha. We think the recent escalation and ratcheting up of US-Sino trade tensions does potentially increase the risk of a full-fledged trade war, but eventually we think cooler heads will prevail. On the commodities side, I think the biggest announcement this week was that China would target the U.S. grains, and particularly soybeans. Those are produced largely in Midwestern U.S. states that largely supported Trump for his bid for the White House in 2016. And it's something that will definitely hit the average American. Whether the opening bid from the Chinese and the 25% retaliatory measure on U.S. grains exports will materialize is interesting to see, because we don't think they can simply source supplies from Brazil and Argentina alone. So this might be a pretty aggressive step from China as a countermeasure to U.S. tariffs in order to bring both sides to the negotiating table and hopefully see some de-escalation of these rising trade tensions, which clearly have ratcheted up sharply since mid-March.
Well, Aakash, that really is the hope, that it brings both the economies to the table and there is some de-escalation of the war that we are seeing right now. But Jonathan, coming to you, while of course the agro-commodities is one part of it, the crude oil prices also have had it bad. We're closing this week on a negative note. Where do you see now prices taking it from? Is it going to be macro? Is it going to be the individual fundamentals that will drive the prices from here on?
Yeah, well, I'd certainly like I can't wait to wait for that day when it actually does start acting and we can get a little bit more news out of OPEC or supply and demand. But you're 100% right. I think the focus is on US-Sino relationships at the moment. I do get a sense that crude is actually, whilst it's in this range, it's actually relatively positive, because whether it's going up or whether it's going down, at least our books can balance themselves out, because we don't have these large fundamental moves. We don't have these large technical moves. So at the moment, I think whilst it stays within this band, I'm quite comfortable with it. Before we went into these trade discussions, we had this upward bias. I still feel that's still with the market at the moment. But once again, it's all been overshadowed by the Sino-US trade negotiations.
So, Jonathan, but what is your overall sense on the crisis going forward? How do you see this quarter panning out?
I generally feel that it still will close on a positive note. But I do get a sense that when we pick up more supply, when I look at the current macro in terms of GDPs, there is this, feeling that things will slow down as a result of what we're seeing. And if that's the case, demand will also start to slow down. So I think we're looking for prices to continue relatively bid and trade to the top end. But I don't see that lasting. I actually see that more supply coming on tap, and I actually see prices actually start to come off a little bit. I think, as we know, prices too high tends to restrict the demand, restrict economies. Prices a little bit lower tend to expand. So given where we are at the moment, I would say we're in for a little bit of higher prices, but at the end of the day, they should come back lower.
All right. But Jonathan, what is your sense on the crude oil prices now? Because the street clearly is divided. Some reports suggest 50, the others 80. What is your own range?
Well, I think the consensus you actually hit on that. We could try and get a little bit closer than that. But I think when you do look at it between, that 60 and 65, that's where we'd like to see it. I think if I see it up around that 68 area, I think it's expensive. If I see it 60, then I think it's cheap. So I guess trying to get those levels, it's hard. It's a commodity where I think you can just trade the range, and that's exactly what we're doing.
All right, so expected to consolidate and stay firm in case of the crude oil prices. But Aakash, coming to you now, it's not just soybean when you look at the agro commodities, but cotton, corn, wheat also form the part of the China list, which has a lot of agriculture commodities there. How have you seen the rest of them perform?
Yeah, so the list is largely targeting agriculture commodities in the U.S. Initial list of $3 billion worth of products. On the agriculture side, it mainly directed towards specialty crops, pine nuts, fruit, certain wines. So it was largely absorbed by the market. I think the big surprise there was one on pork. But China can probably withstand an import tariff on pork against the U.S. because right now it has large local supplies and local prices are actually quite low. So they actually can go after the pork trade a little bit in the U.S., which is much smaller than soybeans and corn. On the cotton side, they actually already have a tariff rate quota in place. They're not a major buyer of U.S. cotton per se. They're not a major buyer of U.S. corn. Actually, China is the second largest producer and consumer of corn globally. So they're actually very self-sufficient. They actually import around 5 million tons per annum globally. So it's not a big impact, we think, for U.S. corn exports, which has a lot of other buyers, South Korea, Mexico, Japan. On the other hand, for soybeans, it's a game changer. China represents 2/3 of the global soybean trade. U.S. sends over half of its soy exports to China, and Brazil sends nearly 2/3 to 3/4. So China is the big game in town there, and there we're seeing the sharpest impact, both from market perception as well as the potential changes in plantings down the line.
You know, Aakash, the view really is that since these tariffs are still proposed, there is not a start time to it, and the negotiations perhaps could go on in this month, may spill over to the month of May as well. So how long do you think that the markets can sustain a wait and watch mode? How long can the uncertainty go on?
Well, on the U.S. Trade Representative side, there will be a public hearing in the middle of May, so around May 15th. And we're currently in the middle of a 60-day comment period, which will allow feedback. Notably, the American Soybean Association, as well as several biofuel groups in the U.S., as well as other farming lobbies, have already petitioned against these moves by the White House and the executive branch on putting these measures and tariffs on China. The auto sector has also been quite aggressive in decrying this type of move. On the Chinese side, look, it was a stronger retaliation. They put up $50 billion worth of tariffs at 25% on their target list of 106 products, similar to the 1,300 products that the U.S. did just a day earlier this week. So we have to see what China will do. I think they're in a little bit more wait-and-see mode because they haven't announced a date of implementation. They're actually waiting to see the U.S. reaction. But I do think this uncertainty persists. From an asset market standpoint, there is some more optimism in the last 24 hours that cooler heads will prevail. You're seeing this in the performance of risk assets such as equities, as well as a bit of a rebound in commodities markets over the last 12 to 24 hours. So there is hope for that. But yes, this uncertainty is likely to prevail at least for a few weeks because on the U.S. side, we probably don't have a definitive answer until after late May.
All right, and that clearly is not a very good news. And I understand that we are talking a lot of commodities here. But Jonathan, the metals have had it really bad. We are closing this week in the strongly weaker side on this one. Anything that tells you is a buying opportunity in this sector?
I think so. And I'm starting to lean a little bit more towards sort of being a little bit more overweight in the copper market, just purely because I just see there's good value there at the moment. You know, we continue to forecast a deficit in that metal, and I think the cheaper it trades lower, the lower it trades, the cheaper it gets.
All right, copper it is then. But Jonathan, precious metal perhaps is the only area that has been getting some attention because of the safe haven buying. But we haven't been able to close above 1350, 1360 kind of levels. Are the current levels a good time to buy though?
I tell you, I always get excited when we're up about 13.50 because I am looking for that break through that 13.60-65. That's a key level for me. If we do see that break when we've got some good things, can actually see it trading up through that 1400 level over time. I actually feel that it does look quite positive. When I look at it from a technical basis as well, it actually looks quite constructive. So the current price volatility we're seeing, in my mind, suggests that a base is trying to form. And I think when we finally break through that, then we've got some good things to the top side for gold and also for silver. So I still remain very bullish, both those metals. Not sure of the consequences as to why they will trade higher. I just hope it's not that dire, but from a technical point of view, they look quite positive.
And Jonathan, it's not just commodities or equities. The currencies, of course, have been taking a lot of impact from what's happening between US and China. What is your sense on the US dollar from here on? Because that really seems to be trading on a firmer note, a 2-week highs as we saw in this week.
Well, I think at the end of the day, there are other ways to stimulate economies. And, I get a sense that the US dollar will remain weaker over time. I know a lot of people are sort of forecasting it to remain relatively well bid, but I think there's a lot of international monies we know tied up in the US, and I think if people get a sense that they want to move that back home, then the US dollar will come under pressure. I also think the US dollar coming under pressure will help the US in terms of its exports, and if it helps its exports, then the domiciled comments by Trump about motivating homegrown stuff become more relevant. So at the end of the day, I think the US dollar will be weaker, and I think that should be pretty positive.
All right, we will watch out for that. Jonathan and Aakash, thank you so much for joining us and giving us a sense on what to expect really from the kind of uncertainty that's brewing up in the global markets because of the US and China spat. With that, it's time for a short break now, but stay tuned. We have Manish Singh, Chief Strategist and Head of Investments, Crossbridge Capital, joining us on the other side.